Are you a broke loser? Do you want to stop being a broke loser? Well, buy my book on Amazon. It's $2.99 for an ebook or $9.99 for a hardback. It's called Stop Being a Broke Loser. If you buy this book, you will no longer be a broke loser. So buy it now. Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon for $3, and still a hater of Unity software stock. Now, I made a video a couple months ago where I said Unity is too unprofitable, too speculative, and it's not a good buy. And of course, what happened in this ridiculous market? Unity goes up. So in the last month, Unity was trading at 107, and now it's trading for 126. And then over the 3 months, it's gone from 93 to 126. So let's see. 126 divided by 93. 35% up in the last 3 months. So, strong man, you're stupid. You just don't understand stocks, bro. Well, guess what? I still think this company is freaking ridiculously expensive. And it is way, way too speculative. And I'm not touching this stock until it falls by maybe half, maybe more, to even consider buying this stock. Now, here's why. I'm on the Everything Money software, and I know a lot of you don't like Everything Money because they look at fundamentals. It makes you mad. It makes you angry. You want to scratch people because it's all about the future and growth, right? Look, price to sales ratio, almost 50. That is highly, highly speculative. So basically, to buy this company, you have to pay $50 for $1 of revenue. Not profit, revenue. That's freaking ridiculous. So, but the PE ratio, if it was profitable, it would probably be like 200 right now, depending on the profit margins, 250, 300. That's pretty freaking ridiculous. But of course, right now, they're not profitable. So I always like to look at the income statement. And you can see revenue's been going up. That's good. I don't know what's going on right here. I think this is a bug right here. But over the last 3 years, revenue has grown. That's great. Operating income, negative, 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 and increasing. But strongman, that's from R&D. We'll get to that in a second. Net income, negative, 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 and increasing. So it's not profitable on a accrual basis of accounting. Now, some counter arguments people made to me was, strongman, they're investing a lot of money into R&D. And that's true, they are. They're putting a huge amount of money into R&D. Let's add back the R&D, all of the R&D expense, and let's see the company's profit margin. And then we're going to put that into the stock analyzer tool, and we're going to see if it's a good deal even at that point. So their revenue for 2020 was $772 million, and their R&D was $403 million. So right off the bat, let's see how much of their revenue they're plowing into R&D. They're plowing 52% of their revenue into R&D. So this is a big, crazy growth company, okay? Now, their net income was negative 282. So let's just say we add back the R&D expense, okay? So we add $403 million. That's $121 million of profit divided by revenue. 15% profit margin, assuming they don't spend a freaking dime on research and development. And I did it for the year prior, and it was like 17%. So their profit's still going down, even when you factor in or you add back R&D. If they don't do any R&D. Now, and we'll address that. Let's look at cash flow. Cash flow from operations. Negative, positive, negative, positive, negative, negative. So it's just all over the place. But right now, it's bleeding money from operations. It's not even making money from its actual business, which tells me they're probably going to be issuing shares, diluting the shareholders. Maybe. 8 pillars. Not enough data. Crazy. All right, so let's go look at the stock analyzer tool. So this is what I use to figure out, or use different assumptions to figure out if this stock is a good buy or not. Let's look at revenue growth. Now, over the last year, revenue has grown by 88%. And you may be like, well, your assumptions are low revenue growth, 30%, middle, 40, and 50 high. Well, number one, you do want to be a little conservative, especially with a stock that has a 50 price to sales ratio. And on top of that, this is a 10-year analysis. So what I'm saying is over 10 years, revenue is going to grow at 30% on the low end and 50% on the high end Every freaking year, compounded. That's a lot of revenue growth, all right? So, worst case, 30% revenue growth. Best case, 50% revenue growth. Share change. I was nice with this. I said, worst case, they're going to issue 2% shares per year because they're bleeding money from operations. Middle case, none. High case, they buy back 2% of their shares per year. Profit margin. Remember, we talked about that. If you add back the R&D, that's a 15% profit margin. I was nice, though, and I said, well, on the low end, let's say they have a 15% profit margin, 20% on the middle end, and 25% on the high end. Same with free cash flow as a percentage of revenue. Price to earnings ratio, I was a little nicer with that, too, just saying, oh, it's a growth company, so I'll give it 15, 70.5, and 20. Now, desired annual return. If you're going to buy an individual stock, you want to blow the market out of the water. So you want at least 20%, 17.5, and 15%. Analyze. So, look at the buy points for each level of profit. 15, 17.5% annual return, and 20% annual return. Now, if the best assumptions are true, then this stock is a screaming buy and it is undervalued by 50%. But you have to believe they're going to grow their revenue at 50% compounded every freaking year. They're going to buy back 2% of their shares. They're going to have a 25% profit margin. That's pretty freaking profitable. Price of free cash flow, 25%. And they're going to have a PE in 10 years as a much more mature company. And then we don't even know what competition is going to be out there, of 20. If that's the case, and you want a 15% return, this company is a screaming buy. But if you're wrong on any of those assumptions, any of those top line assumptions, well, guess what? You're screwed, okay? Because look at the middle assumptions. If you take the middle assumptions, it's a $67 stock. No. It's currently trading at $126. I don't care what anybody says. I don't care if the stock went up recently. I'm not buying this stock. I'm not risking my money on a company that's bleeding money like freaking crazy. And hopefully, maybe in 10 years, I'll make a ton of money. Especially during this insane speculative bull market. That is my argument. I have not changed my mind about Unity. I don't buy companies that aren't profitable and that have negative cash flows, especially from operations, because that's bad. That means they're not making money. Anyway, if you like this video, like my channel, subscribe to my channel, tell your friends about me. Don't buy Unity stock unless you want to speculate, whatever, because, what's his freaking face? George Perez told you to, George Lopez, whatever his freaking name is, then you go right ahead, but I'm not buying it. Talk to you later. Tschüss.